Good afternoon, everyone. It's a pleasure to be here, and always appreciate being the last panel in the afternoon that stands between food and drink. So thank you all for sticking it out with us and attending this panel. Indeed, we are going to address for you the capital markets outlook for the United States, and importantly, the effect of foreign capital on that outlook. Obviously, as we embark on our day-to-day business, it's hard to not read a headline about foreign capital and its influence. Again, just by introduction, my name is Brian Ward, President of Capital Markets and Investment Services for the Americas, and I'm going to let the panelists introduce themselves. To my left,
David Arthur, and I am with Brookfield Property Group. We're an investor across all major asset classes: office, retail, industrial, multifamily, and hotels. Our geography is US, Canada, UK, Western Europe, Australia, and Brazil. And we're a public company. We invest both through our public companies like General Growth and Rouse on the retail side. We also invest through private funds, which we raise capital from a variety of different sources and are the largest LP in those funds. And in terms of our investing activities, we are primarily investing in larger, complicated transactions that are either portfolios or private companies or public companies, challenging transactions, large. And my particular responsibility is investing in the Americas.
I'm Gayle Starr, and I am in charge of the capital markets for Prologis. In that role, I'm in charge of all of the debt other than the public bonds, which means all the corporate debt, all the project level debt globally. We're in 21 countries. In Asia, China, Singapore, and Japan, Western Europe, Mexico, Brazil, and Canada, as well as the United States. My main focus is on structuring financing, natural hedges in different countries. I deal with banks and capital providers globally, and thank you for inviting me on the panel.
thank you.
Hi, I'm Glenn Lowenstein. I'm the CIO of Lionstone Investments, and very honored to be here. I've not been to ULI in a number of years, and also very honored to be from the city of Houston and hosting this group. Lionstone manages $4 billion in assets under management in 17 cities, and I would say our competitive advantage is our research. We spend all of our time figuring out where there's rental growth and figuring out where capital may not fully price that. And so I think one of the reasons we've been successful in this market is that we are in Houston, and we have been able to recruit people to Houston who are very talented, and there's not a lot of competition for what we do here. So just wanted to throw that out. Glad to be here.
Thank you. So for myself and my role as the president of the Americas for Capital Markets, Colliers International, one of the largest global real estate services firms with more than 500 offices and more than 16,000 professionals. For myself personally, one of the great fun things I've had an opportunity to do is interact significantly with global capital over the last couple of years as it's evaluating risk and return opportunity. And so that's been, again, a really interesting opportunity for me, and hopefully I'll be able to impart some of those experiences as we go here. In terms of the outline for today's discussion, I wanted to kind of set the stage with respect to where we sit globally, and then, of course, where we sit in the United States, and then talk about the debt and equity capital markets, and then finish with some discussion on opportunity and, of course, risk. So with that, just to kind of set the stage for all of you, for 2014, we had roughly $40 billion of foreign direct investment into U.S. real estate, representing roughly 10% of the total market. For Q1 of 2015, we had $22 billion, comprising roughly 17%. And for all of you math whizzes, obviously, that translates into about $88 billion on an annualized basis. So if the current pace were to hold up, it's a massive, massive increase in terms of foreign investment into U.S. real estate. So the trend is certainly setting itself up for that. At the same time, when we look at the global dynamics, we've got a situation in Asia, and particularly with China, where we have slowing GDP growth. We're obviously very conscious about what's going on in Europe right now with quantitative easing, and yet to find certainty in terms of escape velocity in those economies. So there's some broader challenges going on. And of course, here we go in the United States, we appear to be forming a fundamental recovery. But I would be curious to get your observations. David, starting with you in terms of what you're seeing out there from a broader macroeconomic basis, and where do we go from here?
Well, Brian, from our perspective, obviously we, as I mentioned, invest in a number of countries, so it's an allocation of capital between different markets and how we measure risk and return in those different markets. The U.S. today for us remains our principal location for investment. We have a global fund that we're investing today. We expect 50% of that capital to be invested in the U.S. and 50% outside of the U.S. And when you look at the drivers of growth in the U.S., it's still a very solid market. Job growth, which is a major driver of real estate demand, is steady. It's not, blowing the doors off, but it's steady. And you have rising real estate values, and you have capital from around the world that sees the U.S. as a principal place and stable place and transparent place to partner with operators like ourselves. So.
Okay. Gayle, what about you?
From the debt perspective, it's interesting to note where our interest rates are with the rest of the world. We're 100, 150 basis points higher. If you look at the 10-year here versus in Japan, and you look at it in Europe and the UK, we're still higher by 100 to 140 basis points, which is interesting when we think that we have very low interest rates. And that somewhat influences the flow of capital. And it also influences those that can take advantage of global debt to be able to borrow in Europe rather than borrow in the US and vice versa. So, it's the first time I've ever seen it, I've been doing this a long time, where we had to write into our loan documents that Euribor and Japan LIBOR can't go below zero, because they did go below zero and the banks started to get nervous. But I think there's a lot of, interest rates are tough, because if you look just at the US, you'd say economic indicators are going to say that rates are going to go up, but there's so much more of an influence beyond just what happens in the US. You hear about Greece, then our rates go down because we're the safe harbor. There's all those different indicators which will affect interest rates and the flow of capital.
Glenn?
Yeah, if you look at GDP, we don't think GDP is going to make interest rates go up very soon. And really, the way we look at the U.S. is there's two different nations. There's a nation that's growing at 2.7%, and there's a nation that's growing at 1.5%. And the nation that's growing at 2.7% is about 26 million jobs that make something that the world needs. And so, and the rest of it, without being too pejorative, are people making hamburgers for each other. It's a US-only kind of economy. And so when we connect these dots, it's the best place in the world to invest. In our view, we're US-only and have no desire to go international. But there is, if you look at the higher social level, a world of have and have-nots. And that world is translated into healthy tissue, and I wouldn't call it unhealthy tissue, I would just call it soft tissue. And so, just as an opening salvo, that's the way we look at it.
Okay. Yeah, I think that's been my observation as well so far, is amongst the basket of alternatives, when you look at the global economies, the United States, relatively speaking, is showing, showing a lot of positives. And so I think that that's driving a lot of the move in foreign capital. I think it's in the case of China, for example, I don't think it's a run for the exits type of event occurring there. I think it's about diversification, hedging risk in relation to return. So we're seeing just a tremendous amount of wealth, a tremendous amount of capital, really moving around the globe at speeds we've never seen before, looking for opportunities at a time when there's just fundamentally probably too much capital chasing too few real estate assets in general. And I think we could probably say that's a global phenomenon in terms of what's going on. So I mean, for sure, I think I'm seeing the same thing. Gayle, you had touched on interest rates, and I really want to get into the discussion about interest rates because, again, like foreign capital, it seems like we can't seem to have a discussion or read a periodical without there being some discussion or forecast on rates today. I mean, where do you see things right now? What are the factors in play that ultimately are going to cause our central bank to move? And then also what I'd ask you guys to think about in terms of that discussion is we've obviously seen a really fairly significant move in Treasury yields here in the last couple of weeks. And any sort of observations there in terms of how that's affecting the markets?
Well, I think they've moved like 40 basis points in the last 30 days or so.
Yeah, they've come back in a little bit since,
right.
But yeah.
But it's like every time an indicator comes out, they go, they're so volatile that it's really tough. And I think the volatility, if you talk to a lot of the bankers, we see a lot of bankers that come through. I mean, the general view from the bankers is nobody thinks rates going to go up significantly, absent what happens globally. And that's where you can't control because, the news is so affecting the volatility in the rates. And I guess I read several things that said that the latest sell-off was due to fixed income sell-off. They sold off because rates in Germany went up, so they moved some of their fixed income to Germany and out of treasuries. So I mean, there's a whole lot of different components that go into it, and it's very hard to predict.
Okay. Glenn, any thoughts?
Well, we fix everything because, I have a view and we spend a lot of time in our firm talking about what interest rates will do. But our general policy is that our job is to deliver real estate returns, not take interest rate risk. And so, look, I think if you ask what's going to happen in the future, to me it's all about GDP US. You can make it really complicated with currencies and various rates around the world, but if the US starts growing and gets and it's more about the US to me than China, and gets world GDP to get above 2.5%, and the US starts to come out of its sort of heart attack recovery mode and actually is walking fast instead of walking slowly, then you're going to see rates rise and go to a normal 3 to 4%. I don't think we get back to 6. That's just my own opinion because of global capital flows. I also think there's another dynamic that's going on, which is when you look at volatility, to me it's all internet-based. You get emotions and herds running very quickly, like small fish that move around in the ocean. The internet, the temper tantrum, what happened in January, it moves the base 10-year treasury 40 to 50 points quickly. And again, as a long-term real estate investor, we don't pay that much attention to it. We don't see, if interest rates go above 3, 10-year, 3.5, you're going to see move in cap rates, But until that happens, we're not thinking about it a ton. We do our base case and we say, it's kind of 3% for us, 10-year treasury. As a CIO, you have to have a policy. And so our view is in the short run, below 3, in the mid to long run, above 3. And we kind of make that judgment and then fix everything.
Okay. David?
Well, I certainly agree with Glenn in terms of long-term assets, fix it with long-term debt. The only exception for us is if we're doing a development or we're doing a significant value add, we'll float rates for a while. But we also don't want to take interest rate risk. We're in the real estate business. But translating that to how we underwrite, so we will use a yield curve, forward yield curve, and assume rising rates over time. So if we're putting debt on partway through a hold period, we'll assume a higher cost of debt. And generally we think about a 100 basis point increase in debt will over time translate into a 50 basis point increase in cap rate. today there's just so much capital chasing assets that I think cap rates are a bit sticky.
Okay, okay. So riddle me this, you guys. We're roughly 6.5 years into a recovery. If you think, I guess we can argue, specific dates, but if you think the trough of the market was sometime, in the fall of 2009, thereabouts, we're roughly 6.5 years into a recovery. We've had unprecedented global liquidity, and yet here we are 6.5 years later, still struggling globally to reach escape velocity. We have very, very modest GDP growth, basically no inflation. I know in my career I've never seen this before. What do you guys think?
This is by far the toughest market. I've been doing this for 30 years. And all I really do is buy buildings and sell buildings and hope that we manage them okay. I think that at this moment in time, we're not in a bubble. There's bubblets around. But I think anything you buy has to be able to withstand a 10 to 15% correction, pricing correction, in the next 3 years. It's going to happen as sure as we're sitting here, and it's probably some sort of, it probably looks like 98 or 01, maybe a currency lockup because the dollar's in a weird position. It may be an industry catalyst like telecom. But I think it's going to happen. And so that is what makes, to me, buying so hard is that question, because it has to happen. And even though I think logically this recovery should take longer given the way that it started, right? It's a 1929 moment, not a general overheated economy recession. I still think that you've got to be prepared for a jolt in value, and then you go back to Priceline, probably. But it's going to happen, and it's a financially induced, stressed moment that's going to happen.
Gayle?
I think from the debt perspective, what's interesting to me is that there's a fair amount of discipline for the debt providers, the more sophisticated ones and the larger life companies, that they really are focusing less on loan to value and much more on debt yield and coverage. And part of the reason for that is they're looking for what's going to be that normalized interest rate environment and what happens if there's some type of reversal in terms of value and rents. So you're seeing that focus. They want to see, generally, who I talk to, these are the more institutional guys, they're looking at 9 to 10 debt yields, and they're being pretty vigilant in doing that.
Okay. For the audience, explain what debt yield
A
is.
debt yield is your NOI divided by your debt amount.
It's basically
So
your debt
effectively,
cap
it
rate.
tracks where your income is. It's similar to coverage in a different way, but it tracks where your income is so they can always judge, and I think that's how they look at their debt on an annual basis to evaluate, is it risky or not risky, because effectively your income's tracking your loan amount. That's why it makes IO so difficult in that your loan amount never changes, but your income could.
So 9 to 10 is high, though, right? So you're saying lenders are getting conservative because of this question. Is that right? 9 to 10 to me sounds high.
9 to 10 seems high, but that's and where they'll reach, and I spoke with a few before I came here, where they'll really reach is where it's a ground zero, great property kind of situation. But tertiary markets, they're in excess of 10. So they're not, the capital is not so free that it's gotten stupid again like it did last time.
Any thoughts?
Yeah, I mean, I would agree. I think when you look at it, when you're looking at the different slices in the capital structure, obviously the debt and the equity, for us, we're maintaining pretty conservative underwriting standards. Our loan to values have dropped in terms of what we're programming. So even though we may run a fund that says 70% leverage, we end up doing 55%. And, so I think you're managing your risk with long-term leases, good credit judgment on the income stream, putting long-term financing in. And I think you can, this is a long-term investment business. It's not a monthly trade.
Okay. So for my part, I have this monthly dinner or so I have with 5 or 6 of my friends in New York, and we get together and we crack a bottle of wine and we sort of talk about what's going on out there and trying to make sense of all of this. And it's been I can't name names, but it's really interesting to get their thoughts. And when we talk about this dynamic of being, roughly 6.5 years into this recovery, some of the smartest minds in our business all sort of acknowledging that while there's optimism and we see the formation of a recovery beginning to take place, some concerns about being in uncharted waters right now, and what that all means, and ultimately how you play this part of the cycle. And I suppose no cycle really ever completely repeats itself, but there is definitely some trepidation about things. And again, it's not like people are being bearish, it's just that people are trying to understand how to play this part of the market. And really what I wanted to get to next is when I hear you talk about the concerns that we may see some sort of correction in the next 3 years, and when I hear you talking about 9% debt yields, are we headed back into a market where we're seeing not more conservative underwriting and more conservative loan standards, but more aggressive loan standards? So I'd like to shift this next part of the discussion to debt and equity underwriting. Who's out there playing? Let's talk about sort of the universe of life companies, banks, GSE, the whole 9 yards. Who's out there? How is foreign capital affecting the overall marketplace? Is it affecting it? Let's talk about underwriting standards. Let's talk about IO and the whole 9 yards, to give the audience sort of a perspective of where the capital markets are at and where they're probably going for the balance of this year and perhaps into next. So how about let's start with you.
That's my favorite subject, debt. Everybody's got capital. So in other words, doesn't mean there's capital for everybody, but everybody's got it. And what I mean there is that the banks, the life insurance companies, they're falling all over each other. I mean, we put out a quote for a $60 million secured deal. We haven't done secured mortgage debt in 3 years because we've been doing mostly even unsecured in our funds, which is a new thing also. You're finding that lenders are more willing to do, at a fund level, unsecured debt than they had previously if they like the sponsor and they feel the credit's there and they get covenants. Their preference is mortgage debt, obviously, but industrial, they have a real hard time finding industrial borrowers, and if we're not borrowing on a mortgage basis, you can imagine they're light in the industrial area. But in any event, the life insurance companies will do 5-year floating. Some of them will do 7-year floating. The banks will do 5-year floating. They'll do 7-year. And some of the ones like Wells and a couple others might even do 10-year fixed. So they're falling over each other, and then you're hearing about what Fannie and Freddie, and they put the brakes on a little, but I heard from Diana Reed earlier today that they pulled up a little on that so that there's a little more freedom there. But there's a lot of capital out there, and there's CMBS capital. The CMBS capital is a little more now than it was last year, but the underwriting standards are not what they were and what they called, and I love this terminology, the Niagara of funding. Like the Niagara Falls of funding. I guess it's what they called the heavy times in '07. And basically that's why, because in CMBS, the rating agencies are actually paying attention this time, and they are looking at which markets they are, what the leverage is, and what the IO is. How long are these interest-only periods? And the last time around, you could get 10 years interest-only, maybe 60 to 65% debt. At a value that was pretty aggressive. Those are hard to get, I think, now, unless it's a really great property. When you have a really great property in a great location, the competitiveness is pretty significant. Okay. But short of that, there is some discipline in the underwriting.
Personally, I'm seeing more and more increase in IO across the board,
but
longer term.
10 years IO?
Yeah.
65%,
Yes.
65% LTV?
Yeah, close, 50 to 55.
Great, 50-55, big
Yeah.
difference.
Yeah.
50-55,
Yeah.
we
Yeah.
can get IO too.
Right.
But pushing it 65, that's tough.
Gayle, who takes the place of a lender like GE, who was a big part of the market now that they've left the market?
Well, so GE was not, I'm like the worst person to ask. We're at like 35% leverage. And so, but
So you're not a GE borrower?
we've never been a GE borrower, except in Mexico, because they were a great provider in Mexico. But I think it's interesting. Some of the life cos actually have mezz funds themselves. So they'll give you the senior debt. They have another fund. They're raising, Pru's got one, I believe Met one does, and they'll actually put a separate group of them will put Ms. debt on top of their senior debt. So there is that for the right assets.
So, I mean, we have a mezz fund, and we lend between 60 and 80%, and we'll take the whole thing down and find the senior and take the junior piece.
Look, to me, the canary in the coal mine is CMBS. It was 55% of the market in '07. Today it's 30%, up from 22% last year. The insurance companies that filled the market, and they're probably in the room, in '09 and '10, they became 40% of that market. They're now down to 15 or 20%. So they've lightened up. They've kind of said, hey, this is a pricey kind of moment. So to me, like at Lionstone, what we look for are the road signs that say caution, icy bridge. And even though I think that everybody does have some post-traumatic stress disorder that will continue for a generation because of the GFC, I still think that the road sign, one of the big road signs we look at is this, what the CMBS market is doing, and it is, even though it's regulated, it's encroaching into the higher risk loans.
No, it is.
The other thing I think that happens is that we had one loan with GE out of 100 projects, and we don't borrow a lot. And I remember when we did it, it was like, it felt odd to me. I'm sorry if there's anyone here from GE, but we don't borrow a lot, and that was a higher risk loan. And what it ended up being was a moment where we were trying to do a dive from the 10-meter board, a triple flip, double somersault kind of dive. And I was like, okay, everything has to go right. We got the loan and this and that. It turned out to be one of our worst investments. And so I think in the understanding of where we're at, and in fact, what most foreign capital is really trying to do is more of a swan dive. And they may take lower yields. This is not all foreign capital, because it's gone everywhere. The foreign equity is everywhere. And it's crowding out the usual suspects. But I think when you look at the headline news on the foreign capital that's coming in from Norway and China and Korea and so on, they're doing swan dives. And they're very conscious they're doing swan dives. And they're very smart. These are really a lot different than when ERISA in 1973 was started and people started to manage pension funds. These are, in many cases, have more exposure to broader capital market issues than the people that are managing their money in real estate. So anyway.
Yeah. No, I would echo that based upon my observations. I'm working extensively with foreign capital. I think they're far more well-informed today than they've been in past cycles. They're much more judicious about how they're approaching the market. They're thinking about it much more long-term. I've also seen somewhat of a shift, and it's always dangerous to generalize, but one from being, in some respects, unrealistically yield-driven to much more realistically capital preservation driven as I see them start moving into this market. And so while again it's not the case in every instance, we're seeing much more prudence from foreign capital. That being said, again, you guys, you heard it here, there's, for the first time, way too much capital chasing way too few real estate assets. So at some point, capital is going to compete. It's going to compete for the best real estate. It's going to compete for the best borrowers, and something is going to have to break here. And what I think I hear you guys saying is that the capital markets are being prudent. My question is, are allocations starting to get more aggressive, and is there going to just be more and more pressure here in this next year that may cause that prudence to go away? Any thoughts?
Well, I think the capital is already pretty aggressive. There's already a lot of capital chasing transactions, particularly if you're in the major markets for really top A quality assets. There's just a lot of capital chasing those assets. And on the equity side, I think you're seeing direct deals from foreign capital. They're investing directly. They're investing through joint ventures or funds, participating in funds. But I mean, I don't think I don't know how much more aggressive you could get with cap rates trending below or close to 4 in some of the major markets. So I think it's a trend we'll see absent of any unknown shock.
Okay.
And on the debt side, I think you're seeing on exactly those same type of assets, it's getting very competitive. So there is a lot of liquidity, but it will get very competitive on those type of assets. On top of which, you're going to start to see some of the European banks that left the U.S. for regulatory reasons in Europe. I know a French one and a Dutch one that actually are reopening this year here, because you can't be out of this market. So you'll start to see that foreign capital from a debt perspective be available again. So there is a fair amount of liquidity. I just don't think it's as stupid as it was last time.
You know, I saw an article very recently about some discussion about relaxing FIRPTA for pension funds, for foreign pension funds, and it really surprised me to hear that, or to see that, excuse me, because you would think at a time when the market is so fully priced and there's so much capital that the last thing that the U.S. government would be considering is relaxing FIRPTA, but it surprised me to see that.
Well, there's also a huge trend worldwide where real estate has grown up, and real estate in the boardroom and the investment committee has become an asset class that's favored. It's always tricky for us in real estate when that happens because we want liquidity, but not that much liquidity. And if you look at regulations and standards worldwide now, allocations are going up, and real estate performance has, if you compare it to stocks and bonds and a bunch of different measures, has outperformed over 5, 10, 15 years. So, and the U.S. is growing steadily and has the rule of law, okay? So those two things, if you really look at it around the world, other countries have them, but not in the size that we do. So you have these massive funds in the various countries that everyone has read about that have to allocate capital to real estate because it's a desired asset class and needs some size. And so will it continue? Absolutely. You know, probably if you see bond rates go up around the world, it'll pull back a little bit because an allocation may change. But, you know, when I was growing up, cap rates in Germany were 4, and in the United States was 8 or 9. And 4 was normal in Europe. Why? Because the U.S. had a market that was forming, and Europe had been there for 7 generations. This market has matured, and everyone in the room, you know, that's been around for a while has seen it mature. It's efficiently priced, and with the internet, you know, somebody in Munich who just bought a big building in downtown Houston has the same, more or less, information to process that most people in Houston have. So will it go away? I don't think so. And I think one of the themes that I'm hearing from everyone that it really is, these foreign investors are staffing themselves with the smartest people in their countries and in the world. So they're very sophisticated about what they're doing and why they're doing it. And that means that it's not like when the Japanese came in '86 and priced all core assets. It's not like that. You know, prudent, in a room full of investors, people would probably cringe because they'd go, prices are high, core is overpriced, no one's being prudent. But I actually think if you look at the investments that were made at 4 or 5 caps in 9, 10, 11, 12, 13, 14, they turned out pretty well so far. Today may be a little tricky. So there's tough, good competition out there for investments. And for people selling, it's a great news. For people buying, it's not so good. For people developing, if you get the product up into the jet stream where that money is, you're in great shape.
I think the business case for FIRPTA today is pretty weak, given how strong the market is, and the political case for changing FIRPTA. I don't think we're going to have much success as an industry.
Yeah, it could be tricky. Are you going to comment?
Yeah, one other thing that's worth mentioning is the regulations, the banking regulations and the credit, you know, capital charges, they've been much stricter lately. And I think part of that is showing its result in the fact that for the good borrowers, for the great assets, the great locations, they'll really reach the capital providers well because those ratings on those loans are going to be higher, requiring a smaller capital charge so they can get more aggressive. So all of these bank regulations, stress tests, everything else is impacting the type of debt capital that's available for what assets.
Okay. One of the things that I've seen occur in this last year with foreign capital, when we talk about transparency, predictability, liquidity, definitely the U.S. market just resonates on all fronts. There had been a lot of concern for foreign capital just with the complexity of our tax system and the burdens that the tax system placed on foreign investment. It tended to drive a lot of foreign investors really to prefer markets like the UK, where it's a little bit more simple and a little bit more clear. Today, it's almost like sort of FERP to be damned. It's like, we want to come to the United States because of that. We realize we have excess tax consequence, but the United States is the place where we see the best opportunity for prudent investment and capital preservation. So it'll be kind of curious to see how that plays out. I'd like to move on, if we can, to getting to specific markets. Where each of you see particularly market opportunities, and also think about, as we're discussing markets, perhaps how foreign capital's observations and investment strategies in markets may have shifted. David, can we start with you and get your observations?
Sure. So, I mean, it's no secret that the gateway markets are preferred by foreign capital. So, high barriers to entry, top quality assets are the assets that the large pools of foreign capital are chasing, no question about that. But, there's an availability constraint, and there's a yields being driven down. And I think we're seeing capital move to secondary markets. Some of it's chasing yield, some of it is investing in assets, quite frankly, that were overlooked in the first kind of rush to gateway markets. So definitely markets like Denver, Atlanta, are on investors' radar screens these days, simply because of availability and moving for yield.
Gayle?
I'm not such an expert on equity, only to say that, we do have a lot of sovereign money, and I think, and we're in the major markets, we're in the secondary markets as well. And there's a tolerance for risk, but the expectation there is, like in China and Brazil, that there's going to be quite a return. And then given our sovereign co-investment funds that we've got in the U.S. and in Europe, they're basically, our REIT follows step with our funds. So we don't basically have a risk fund that's different than what the REIT does. So what our funds do, and which is where we attract in the foreign capital or sovereigns or pension funds, they're lockstep with what our REIT does. And so that is, we continue to be strong in the gateway markets, in the strong secondary markets.
Okay, Glenn?
Looking at Mary. Mary's one of the great research people in the industry, and we're a research firm. An investment firm that leads with research. Probably the best way to answer the question is where we don't invest. So we have redlined, we'll not go there, Florida, most of the Midwest, and most of the Rust Belt. And our whole geography of investment focuses on 2,000 square miles. Why? Because that's where the growth in GDP per capita is occurring. And there's kind of two strategies in the U.S. right now. It's buy growth and lock into rental growth, so when this happens, at least you get income, or buy cheap and go to places that are cheap, and if you can buy a lot of cash flow with very little appreciation. And so our view is that the only way to protect ourselves from what is going to happen on the downside in the future is to buy physical improvements that the internet can't destroy, and everybody here knows how the internet is destroying certain types of assets, and buy those. Said a different way, if you look at the whole office market, take office for an example, there's 4 billion feet. If you look at a lot of the ULI stuff that everybody's working on, and you look at walkability and healthy and this and that, about half that 4 billion people don't want. And so even in a net zero new growth environment, you have a shift of existing users over to what people do want that has tremendous opportunity. So in my career, this opportunity is bigger than, I used to work for Mr. Hines, bigger than the opportunity he saw when he went from being a mechanical engineer to being a developer and housed the growing 7% US economy. This is a massive change in preferences. That's the good news. The bad news is that you have to get there one day before the big foreign capital gets there, or the capital that's been crowded out of core into core plus. And that's what the hardest thing to do. So where's our opportunity? You know, we bought a year ago in downtown LA. Downtown LA had been forever flatlined. You guys bought in downtown LA. And there's a trend of liveliness and of coming back to that place that is real and is happening. And now everybody knows it, but for 13 and 14, everybody didn't know it. So the model, I think, is more like Blazing Saddles for those of you guys who are a little older, and toll booth in the desert. You got to be there that day before and buy your fixed asset, and then hope that the internet, or believe or do your research that the internet is supporting that purchase, not destroying it.
So, I mean, the only piece I'll add here is that whether it be foreign capital or domestic capital, we're definitely seeing a move into secondary markets, not so much tertiary markets for foreign capital, but they're beginning to look at options that they might not previously have considered. The only concern that I would ultimately have is in both the past market cycles where we ran into trouble, is capital in general began to not differentiate between asset class and asset quality, and anytime you begin to see capital start to stack up, that event can kind of that risk can begin to present itself. Given our time, I'd like to move to a little bit of a lightning round discussion if I can, and I'd like to hear from each of you what you think the biggest opportunity is for this next 12 months, and what you think the biggest risk is for the next 12 months. And let's just start with you, and we'll work around quickly.
Okay, so it's a 12-month.
It doesn't have to be. Whatever relevant time frame you want it.
Okay.
You don't get 10 years.
Yeah. Okay. No, I'm not a big fan of development because the checklist is so long and it takes, it's complicated. But the opportunity right now is in creating core product, because again, the price line is this, and sometimes, it's lightning. If you can create something and put it into a core market, that's the opportunity.
Okay, and the risk?
I think the risk, I think talent is more valuable today than capital. The risk that we have, that everyone has, is you have to price your talent appropriately in a market that has very low margins. So the risk to me is not on the real estate side. I think the opportunity is pretty clear and decipherable. There's a pricing risk, but the real risk is getting yourself and your company or you into the spot where your talent's valuable, like in the tech market. That's the risk, and not doing that can be not so much fun.
Okay, Gayle?
I think from a debt perspective, I think the opportunity is actually to continue to promote the industrial. Industrial outside the U.S. was not a favored product type. And recently, in the last 2 years, it's become much more a coveted property type, including in Europe and in Japan to an extent. So to the extent that we can exploit that, it helps us both on the equity and on the debt side. On the risk perspective, I think it's more a global issue on risk. I think it's tough in China and it's tough in Brazil. And so we just have to watch those both closely.
Okay. David?
Well, I'll take 2 cracks at opportunity. One is infill mixed-use development in core markets, I think is a great opportunity. We've been buying urban retail, streetfront retail, which we also like as an opportunity. I think that the risks are spec development in secondary markets. Because you can transfer your belief that you're going to get the same kind of yields or the same kind of space demand, and you start to convince yourself you're going to get it in secondary markets, and I think that has not proven itself out over time. And just to Gayle's point about other markets, I mean, we're investors in Brazil, and you can buy. We just bought an office building in Sao Paulo at an 8 3/4 yield, which would be a 4.25, in the US. So if you're prepared to take the risk, you can get compensated for it, and then you got to price your money.
Okay.
I got to do one thing just so we create a little bit of controversy. Everyone talks about the gateway markets, and they talk about, there's so much liquidity and so on. But here's the problem with the gateway markets is that you buy at a 6 IRR and on a lightly leveraged basis or even unleveraged, so much of your yield is from appreciation, way too much. And so, number one, and you go to some what people call tertiary markets that may be actually stronger pound for pound than some of the gateway markets, and you can get still 70% of your return from income. So there's this whole debate out there, and people define these markets so differently, but if you ask me, I'd say Chicago, and this is, is a tertiary market based on its fundamentals. It's like, even though people are paying for it like it's a gateway market. So I think there's some definitions that will change here in the next 10 or 20 years.
I mean, unfortunately, we're at time for this controversy. I would argue that there's really only one risk, which is this market, I believe, was fundamentally built on liquidity. And the question will be, as liquidity leaves the market, how will it ultimately affect our business in general? So, we ran to time. I'm more than happy to take a couple of questions from the audience. And again, I realize that we are between you and food and drink. So, if there are no questions, thank you all very much for attending this afternoon's session. Have a great afternoon.